Hello and welcome to Market Makers. Well, Indian markets surely have seen a bout of volatility of late. We could blame it on earnings, global geopolitical concerns, or simple profit booking. But where do we go from here? Next 3-4 weeks, we are not pitted against a large calendar event. On one side, you got foreign investors who are selling, but domestic institutional investors, they continue to be the back support for this market. Risk versus margin of safety, what is the market positioning? So to discuss all that and much more, I have with me Abhay Laijawala, Managing Director and Head of Research with Deutsche Securities. Abhay, fantastic to have you back and thank you for joining us.
Thank you for having me.
When we met last, this market was riding high on liquidity, and now liquidity is getting completely balanced. Domestic investors are buying, but foreign investors are selling.
Correct. So therefore, I think the liquidity tailwind is getting chilly. Since the beginning of this month, we have seen geopolitical risks globally as well as issues here in India, particularly the fears over the border standoff in China. Have led to some nervousness amongst foreign institutional investors. Net selling has been close to around $1.8 billion or so. So foreigners have been continuous buyers in India since the budget, since February 1. But we have seen a bout of selling this month. In addition, we think that the next couple of months as well, probably the foreign institutional investors might stay on the sidelines given the backdrop of the Fed policy, where the Fed chair is likely going to talk about the balance sheet unwind. We are talking of, or we are expecting that there will be some talk in the September policy, because the Fed has a $4.5 trillion balance sheet that needs to be unwound. And in addition, you also have the ECB, which will have to talk about their own QE, which comes to an end in December, what they intend to do with that. So if there is a simultaneous clearance of throats on liquidity unwinding, it will have an impact on emerging market flows. In addition, even in India, we have our own issuance pipeline coming through. So there's probably close to around $5 billion or so of issuance coming through, a lot of insurance companies, etc. So the combination of withdrawal of global liquidity coupled with the issuance pipeline, which could probably suck out some liquidity from the secondary market to the primary market. So to that extent, probably, the liquidity may not be as benign in the run-up to the end of the year.
So liquidity is one aspect and valuation is the other aspect. We've been making a case that Indian macros are great and earning recovery should start, and with each passing quarter we are realizing that good macro does not translate into a smooth earnings recovery. Somewhere are you getting a sense that investors are getting worried or they're getting frustrated?
I won't say that they are getting frustrated, but they are probably getting more realistic. Up until now, the expectation was that the landmark reforms that India is going through will result in fast-paced earnings growth. But I think a realism is now dawning that many of India's reforms are indeed historic, but at the same time, we will need to see a rebalance take place in the economy as the economy recalibrates to the big changes that are happening in the country. And many of these changes are going to lead to a lot of adjustments, and this will probably mean that we may have to see a couple of quarters of relatively slower growth than what was being anticipated, a few months ago. So to that extent, the downgrade that has happened in terms of earnings is now bringing investors to realize that perhaps FY18 earnings may also have to be revised downwards. And to that extent, the threshold of patience that investors have had is beginning to narrow.
Earnings recovery surely will not surprise us in FY18. Whether it would be surprising us in FY19 is still about 4 or 5 quarters away.
Correct. So in the meantime, therefore, the best strategy is to follow a bottom-up approach. This is not a top-down market at this point in time. This is clearly a bottom-up market, and I think there are some very good ideas out there in terms of companies which are delivering double-digit earnings growth. In those companies, I think we should be prepared for valuations to get stretched, because investors will be willing to pay a premium for earnings sustainability as well as double-digit earnings growth visibility.
You've been bullish on metals and you've been right. Where do metal stocks go from here?
So, metals as a sector, I'll be able to comment on the sector. The sector looks very robust right now, primarily because global growth has begun coming back. In addition, we have seen a weakening of the US dollar. So, the combination of global growth coupled with a weakening US dollar is going to lead to an increase in commodity assets under management. So, in the last few years, with global growth ebbing and the dollar becoming strong, we saw assets move out of commodities. These are, I'm talking of financial assets. And now with growth coming back and the dollar showing signs of weakening, we are seeing a resurgence in commodity assets under management. That's one part of the equation. The other part of the equation is China actually adhering to the supply shortfalls. And we have seen in the case of steel, China has restricted capacity. A lot of capacity has gone out, and that is manifested in net steel exports out of China declining by as much as 30 to 33%, which increases the legitimacy of the supply cutbacks that have taken place over there. In addition, the property market in China has rebounded, and there is a very strong correlation between land sales in China, the property market, and fixed asset investment, which tends to have an impact on steel prices. So, in the last 3 months, for example, Chinese steel prices have improved by as much as $100 per ton. The last I checked, Chinese steel prices were at $580 per ton. So, the combination of all of this, including the fact that the Chinese property market rebound is likely to continue for the next couple of months, which should be very supportive of steel prices. We think that this rebound in metals sector will probably continue. And as I said, in aluminum as well, the combination of weakening dollar and the resurgence in global growth has brought funds back into the commodity space. Aluminum, LME aluminum is now at $2,075 per ton. Zinc has broken 3,000, going to a level of $3,150 per ton. Very, very positive for non-ferrous. So, both non-ferrous as well as ferrous look strong. And I think what's the icing on the cake is the announcement by the Indian government to restrict steel imports by imposing the anti-dumping duties and safeguard duties, and not allowing steel imports below $390 per ton.
Yeah, the MIP has worked like a charm for them. Now, historically, we've seen that metals or commodities, they follow a 2 to 5 year cycle. Sometimes it could be long. And I would imagine that the cycle has reversed about a year ago. So, can I safely assume that for metals, before the metal prices they peak out and before metal stocks they peak out, there is a really long way to go?
I think in metals we had a very long commodity super cycle in the first decade of this century, between 2004 and 2009. But now we are back to normalized cycles. So, my sense is that the cycle is going to be shorter this time around. Difficult to take a call on exactly how long this cycle will last, but my sense is that it is not going to be as long, and it's probably going to be a shorter cycle. But at the same time, while the cycle will be short, perhaps the amplitude and the move in prices may be far more. So, it will be prices will be more volatile, and the cycle is likely to be shorter. That's my sense.
Okay, I quite enjoyed your report on rural reflation. Walk us through that report. Why are you making a case for a strong rural comeback?
So, our view is that a country like India has very little political tolerance for the rural economy remaining under stress. And what we have highlighted in that report is agri GDP growth has now halved. It's come down from about 12 to 13%. This is nominal agri GDP growth has halved from about 12 to 13% in FY 13 and 14 to as low as 7% as we talk. And this has likely come about as a result of many factors, some of which are the global softness in commodity prices. Global agricultural commodity prices have come down. In addition, India has also not raised minimum support prices. We have raised minimum support prices very, very modestly. And I think the time has come to recalibrate our expectations as to just to keep inflation low, can we make farming unremunerative? Now, I'm not saying to make farming remunerative, you have to have an unbridled increase in minimum support prices. That is not a sustainable solution. But the sustainable solutions lie in improving the productivity of Indian agriculture. This can probably happen through investments in cold chains, through investments in infrastructure to basically store fruits and vegetables, and in primarily food processing. Remember that the farmers have shown spectacular success in terms of horticulture production in the country. So while the Indian farmer has lived up to the promise of raising horticulture production, the country has not walked the other halfway to go out and build a system that matches the increase in horticulture production. My sense is that perhaps FDI in retail might be an answer to improving, might be one of the answers. In addition, as we have highlighted in our report, perhaps India needs to have a fruits and vegetables cooperative on the lines of Amul. We saw what happened to milk production in the country after Amul was launched. Why can we not have something similar for fruits and vegetables and replicate an Amul but for fruits and vegetables?
Fair point. So are you making a case that the next bull market would be made on the liability side, and the liability side is the rural economy? So buy into agri companies, fertilizer companies, pump companies, anything which will cement the rural growth, especially at an agrarian level, should be looked into.
Absolutely. So that's what we have highlighted in our report, that we are coming to a situation where government focus is going to move very, very significantly towards addressing rural woes. We are likely to see more proactive government policy. In fact, we saw some action last week itself, where the government restricted imports of pulses, and that has actually resulted in pulse prices which had dropped below the minimum support prices, now moving above the minimum support price. So we will see a lot more action from the government on addressing rural market woes, and in addition, we believe that the terms of trade had shifted very firmly in favor of urban India, away from rural India. And between now and perhaps the next 12 months, we will see the terms of trade coming in favor of rural India. So from a strategy perspective, from an equity market perspective, the view is that we start looking at the entire rural basket and the beneficiaries of rural reflation.
Is it time to buy the fear into IT? Let's be clear here, companies are still growing, and the way stocks are getting hammered for a variety of factors, I mean, markets are now, worried about their core existence.
I think markets tend to climb the wall of worry very easily. Yeah. The time may have come to be contrarian on Indian IT. The model, stock selection will be a key. But the model of Indian IT companies is not broken, and in fact our IT analyst Anirudh Bhosle has been highlighting that that barring the US financial services and US retail, the other verticals are all moving back to normalization. Now, US financial services, US retail is about 25% of the revenues of Indian IT companies. So effectively 75% of the revenues of Indian IT companies, you're seeing the growth drivers normalizing. And in addition, our view is that the margin decline may have probably troughed out. So it is very likely that FY19 could probably consensus expectations for FY19, which are at about 6 to 7% growth, there's probably a chance that consensus expectations could be revised upwards, because in the next few months we may also see the US financial services sector demand start to come back, given that interest rates are likely to move up. The financial sector has recently been allowed to give higher dividends. So if the banks are going to be giving out higher dividends, I'm sure there's a lot of discretionary IT spend which has been held back will probably come back. And finally, even on the rupee, we are probably seeing more tailwinds now for IT than headwinds, which have been quite nasty so far. And the icing on the cake is obviously the valuations. The IT sector today trades in terms of MSCI India IT relative to MSCI India is trading one standard deviation below the long-term average. And in terms of where we had last seen this, I think it was in 2008, 2009. So we are actually contrarian on IT, and we believe the time may have come to start looking at the sector far more positively than we have had.
But would you go overweight on IT?
We are in fact overweight on IT. In our model portfolio, we are overweight on IT. It is a small overweight, but it is an overweight.
Are you also tempted to relook pharmaceutical, or you think the price erosion there is structural and it's here to stay for another 2, 3, 4 years?
Very good question. In fact, in our portfolio, we are still underweight IT. I beg your pardon, underweight pharma. And in fact, it's quite a significant underweight, because as you rightly pointed out, the worry is the pricing erosion in the US market. And here I would like to say that our pharma analyst, Karthik Mehta, has been extremely proactive. And in fact, he warned clients recently that the low valuations in the sector are a mirage. His view is that the derating of the sector still has much more to go, and value is still an illusion. So our view is that last year we saw single-digit pricing erosion in the US market on account of the channel coming together, on account of the distribution channel consolidating. So channel consolidation led to about a 7 to 8%. In the last few months, we have actually seen that 7 to 8% erosion in pricing in the US market move to 12 to 14%. In addition, the US FDA is also now clearing approvals much, much faster. Yeah. So our expectation is that we still have 6 to 8 months to go. We do not think that the erosion is structural, but we think that probably in the next 6 months or so, we would have seen the worst of the erosion. And therefore, probably there is still more time, because consensus earnings for the pharma sector, we believe are still at risk. For example, consensus has cut pharmaceuticals earnings by as much as 25 and 28%. And our expectation is that there could still be a risk of as much as 10 to 15%, if not more, as far as the pharmaceutical sector is concerned.
And they're not cheap. I mean, Sun Pharma, Lupin, the price erosion or the price damage has been there, but stocks are still trading in the teens when it comes to the P multiple.
That's right. And in terms of PE relative, very, very interestingly, they are as attractive as IT services is. Now, remember that between IT and pharma, IT went into the downturn much earlier than pharma. And IT is now looking like it has troughed out, whereas pharma still probably has some more time to trough out. So relative to between the two exporters, we clearly prefer IT. Within pharma, we do believe that there are certain companies which are doing very well, where we are very confident of earnings growth, where we are very confident that there is a low risk to earnings downgrades. So clearly, if one wants to look at the sector, there are good companies within the sector.
Okay. So closing comments now. We've talked about IT, pharma, metals. Give me a sector where you think growth could be at an inflection point, because if you're able to identify growth or the industry or the market share gain at an inflection point, you may see some kind of mini re-rating in the stock.
I would probably be looking at companies that have a high exposure to rural India. Now, I'm not permitted to comment on companies, but certain large companies in the consumer staples industry have seen zero volume growth. Yep. And we've run a lot of correlations, and we have seen that there is a very positive correlation between the volume growth of the large consumer staples companies and agri GDP growth. So if the government is indeed going to reflate rural India, and if we are going to see a significant rise in agri GDP growth, probably in the second half of this year, we could probably see the return or resumption of high single digit to begin with, high single digit volume growth in some of the consumer staples companies. Unfortunately, valuations there are not very supportive, but one would think that valuations will stay supported if volume growth is seen to be coming back.
Okay, so final question, we've talked about companies or businesses which could be at an inflection point, but apart from pharma, where else do you think the consensus growth estimates are not realistic? They are way above than what these companies or the sector could deliver.
Perhaps telecom still.
Okay.
Perhaps telecom still. We've already seen a very significant, but perhaps we could, because we still do not know how the consolidation is going to happen. It's still an evolving process. So the uncertainties haven't gone away. As early as 3 months ago, did we expect that the largest player will announce what he announced recently? So I think it is still a process of consolidation, and in that time period, we could probably still see some more surprises. So, and even on the entire market, as I said, consensus earnings have been cut from about 21% at the beginning of this year to about 16 to 17% now. That still looks to be on the higher side. That still looks to be on the higher side. Sorry, one more sector where I feel there could still be an inflection point could be in the oil marketing companies.
You mentioned that last time.
So similarly, we feel, and our oil and gas analyst Harshad Katkar, who has been amongst the earliest analysts to highlight the game-changing reforms that are happening over here, now highlights that there is no reason for the oil marketing companies to trade at valuations which are very close to commodity company valuations. So his view is that the market is completely ignoring the marketing side, and the market is only valuing these companies due to the refining operations. And in his view, therefore, we are likely to see the market re-rate these stocks. And with diesel pricing now being announced on a daily basis, that has pretty much indicated that deregulation of diesel is well entrenched. And even on kerosene, the expectation is that the government wants to eventually roll out the kerosene subsidies in a very staggered manner, of course. So all these factors mean that the marketing side of the oil marketing companies needs to be re-rated. So the valuation re-rating of the OMCs, that journey has a long way still to go.
I think it adds up beautifully. Okay, Abhay, Appreciate your time. Glad you could join us, and thank you for your valuable thoughts.
Thank you.
That's it on this edition of Market Makers. Thank you for tuning in, and thank you for watching the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.